The year 1907 witnessed a financial earthquake that shook the United States to its core. This event, known as the Panic of 1907, exposed the fragility of the American banking system. It triggered a chain reaction of bank failures, business closures, and widespread panic. This was a time when the American economy operated without a central bank. The financial system relied on a decentralized network of banks, each vulnerable to sudden shocks. The Panic of 1907 was not an isolated event. It was the culmination of years of risky speculation and unchecked financial practices. Understanding the events of 1907 is essential for grasping the significance of financial regulation and the role of central banks. This essay will delve into the key events of the Panic of 1907, its impact on the US economy, and its pivotal role in shaping the Federal Reserve System. The seeds of the 1907 panic were sown in the world of speculation. A group of financiers led by the ambitious Augustus Heinze attempted to corner the market in United Copper Company stock. This maneuver backfired spectacularly, leading to a collapse in the stock price and triggering a domino effect across the financial system. The Knickerbocker Trust Company, a prominent New York bank, had significant exposure to Heinze's schemes. As news of the United Copper failure spread, depositors rushed to withdraw their money from Knickerbocker, fearing for its solvency. This run on the bank proved fatal. Unable to meet the overwhelming demand for cash, Knickerbocker was forced to close its doors, sending shockwaves through Wall Street and beyond. The collapse of the Knickerbocker Trust Company ignited a full-blown financial panic. Fear spread like wildfire through the financial system. Depositors, fearing for the safety of their savings, lined up at banks across the country, desperate to withdraw their money. Banks, facing a liquidity crisis, were forced to restrict withdrawals or close altogether. The impact of the panic was immediate and devastating. Businesses, starved of credit, were forced to lay off workers or shut down operations. Unemployment soared and economic activity ground to a halt. The stock market plummeted, wiping out fortunes and shattering investor confidence. The nation was in the throes of a severe financial crisis, with no end in sight. The Panic of 1907 ignited a fierce debate about the need for financial reform. Many, including prominent financiers, argued that the crisis exposed the dangers of a decentralized banking system. They called for the creation of a central bank, modelled after the Bank of England, with the power to regulate the money supply, provide emergency liquidity, and stabilise the financial system. However, the idea of a central bank faced stiff opposition. Many, particularly in the American West and South, viewed a central bank with suspicion. They feared it would concentrate too much power in the hands of Wall Street bankers and undermine the principles of free enterprise. This resistance to central banking would continue for several years, shaping the debate over financial reform. In the aftermath of the Panic of 1907, the need for a more stable and resilient financial system was undeniable. After years of debate and compromise, the Federal Reserve Act was signed into law by President Woodrow Wilson on December 23, 1913, marking the birth of the Federal Reserve System. The Federal Reserve System, commonly known as the Fed, was designed to address the weaknesses that had been so painfully exposed during the Panic of 1907. It established a central bank with the authority to manage the money supply, provide liquidity to banks during times of crisis, and supervise and regulate financial institutions. The creation of the Fed marked a turning point in American financial history, ushering in an era of greater financial stability and resilience. The Panic of 1907 serves as a stark reminder of the devastating consequences of unregulated financial markets. It highlights the crucial role of a central bank in maintaining financial stability and the importance of prudent regulation to prevent excessive risk-taking. Today, as we navigate an increasingly complex and interconnected global financial system, the lessons from 1907 resonate more strongly than ever. The Panic of 1907 reminds us that financial crises, though often triggered by specific events, are often rooted in deeper systemic vulnerabilities. By understanding the causes and consequences of past crises, we can better prepare for and mitigate the risks of future ones. The legacy of 1907 is a reminder that vigilance, foresight, and a willingness to adapt are essential for ensuring a stable and prosperous financial future. Thanks for joining me on this historical journey. If you enjoyed this trip back in time, don't forget to like, share, and subscribe for more fascinating history bites. Until next time, keep exploring.